Hi all, and welcome back to another episode of the ICIS Energy Foresight podcast. Today we're going to talk about the EU carbon market, and we're going to talk about the future direction. It's alongside gas. It's one of the energy commodities that this year has been trending downward. And unlike previous years, right now, everybody seems to be quite bearish. With me, Lewis Unstead, that will let me understand what's happening and what is about to happen, what might happen over the next few months. Hi, Lewis.
Hi, Matteo. Cheers for having us on.
So I think that the natural starting point is the event which is not happening anymore. So the carbon market, especially the European emission trading system, has been funded with one deadline, which was the 30th of April, which was the last day that compliance operators, aka all industries and utilities and subjects participating in the ETS, had in order to deliver, to surrender their carbon allowances for the previous year. That usually meant that April was kind of a dynamic month because everybody was just rushing towards actually buying the last bit of allowance, the last bit of EOAs to cover their position. This year is no longer the same, and that deadline has now moved to September. Is this the main driver behind the fall of EOA prices?
I think a simple answer to your question is no. No, from our perspective, this is not the key bearish driver. Perhaps if we take a step back and look at what it means for the operators under the ETS with the shift in compliance deadline. The 2023 compliance cycle is quite an exceptional year because you've had since 30th of April 2023 last year when you had the 22 compliance until the 30th of September now this year where you have the 2023 compliance. So 17 months between the compliance deadlines. And typically this has been 12 months between the compliance deadlines. So an additional 5 months to procure your EUAs for the compliance cycle. That's what's changed. And 2023 is exceptional because after this compliance cycle from September 2024 onwards, we'll go back to the 12-month usual cycle. So we're in an exceptional period, but has it really made an impact on the traded balance of the EU ETS? The only real source of impact could be from those small industrial buyers where we assume typically would have a fairly conservative risk management strategy where they buy their EUAs equally over the given compliance window. So this could be spreading their demand over 17 months in this occasion rather than 12 months. And obviously that could be reducing the incremental demand from those small industrials coming to the market to buy their EUAs. But we're talking about, not a widespread strategy for EUA procurement here and smaller volumes involved. So we don't think this has a massive impact. The real impact here, we think, probably is on sentiment. And you alluded to it, Matteo. There's always been a seasonal bullishness around the April compliance deadline based on the idea that there's a risk that those players that didn't buy enough EUAs to cover their compliance obligation might be forced to go to the market last minute to buy their obligation. And we've never been a big believer this is a key market driver. But what is clear is that this has influenced sentiment in the past. And there's always been a perception of this risk. So whether it was the case, whether it's not, the perception has been strong. But this year, obviously, there's an absence of this risk at all. So rather than being a key bearish driver for the dynamics, we rather look at it as taking a bullish card off of the table. It's no longer something that players can argue to support a bullish case on this market. So definitely something that's made a bullish view more challenging to maintain in the first couple of quarters of this year.
Okay, so it's not the new deadline. Let me see if I can get one bearish driver right. What about spark and dark spreads that are negative, that have been negative for a while now, and we're talking about margins of conventional power plants, or the volumes related to the Recovery EU?
Yeah, so this is definitely more like it. And I think this is two key bearish drivers to the market. Looking at the negative spread development, ultimately it's been borne by weak power market fundamentals. So renewable growth is outstripping growth in power demand, which we know at the moment is facing quite a slow recovery towards the pre-crisis levels. That's pushed spreads deeply into negative territory, increasingly reducing the number of thermal hours in which thermal generation is in the money, essentially. For EUAs, what does this mean? Well, when we think about utilities, they are always looking to lock in their positive margins. That means going long on their EUAs and fuel, as well as short, selling their power. This is how they're locking in their spreads, with negative margins increasingly kind of found across the mix. There's less positive hours for them to hedge, and therefore this is having a bearish impact on EUA demand. When we think about the kind of key drivers here behind this kind of bearish development, of course there's lower hedging, but there are still opportunities for utilities to lock in positive margins, and therefore it's contrary to what might be suggested by the negative spreads on an average efficiency baseload level. There's still opportunities for utilities to continue their EUA purchases, be that through peak load, quarterly contracts, or even with the CHP plants that are receiving revenue for their heat businesses. On average, there is less EUA demand coming from utilities, but this is not the case that there's no EUA demand. The key challenge for the EUA market right now is the limited fuel switch potential. Obviously, the market is trying to go on this bearish trend to price in additional demand and find support. However, without this reverse fuel switch potential from gas back towards coal, there's limited scope to price in additional demand from utilities. And that means the EUA market faces limited resistance right now to downside moves. And this is helping support the bearish trend.
That's very interesting because it's a new development. That's something that obviously paired with the explosion of renewables is actually putting a cap to a certain extent, if we can call it such. Additionally, we have EUAs coming onto market with the REPowerEU package. So with the idea of trying to finance part of the energy transition, which is effectively creating a sort of dumping effect, which is posing a little bit, the question, is Europe actually serious about the energy transition since the price of carbon is coming down? Is that the case?
I think definitely with the REPowerEU, it's a factor that's contributed towards the bearish dynamics, because it's this supply risk and uncertainty that's looming over the market. The point is, the lower the EUA price goes, the more uncertainty there is around the European Commission reaching their 20 billion revenue target. They have an implied price target for these front-loaded volumes of 75 euros based on the current volumes they've got on the schedule. We're trading around 15 euros below that today. So the further we go down, the more uncertainty there is in supply. We did a recent modeling exercise looking into the impact of adding more volume into this market to try and meet this 20 billion revenue target. Based on our current forecast, they would fall around 2.5 billion euros short if they don't adjust the volume. So there's an incentive to do something, but they have to tread carefully. Based on our forecasts, we see an additional 50 million EUAs that need to be assigned for the REPowerEU package to reach the 20 billion mark. Whether they will go and do this, well, this is where the question mark lies. And this is ultimately where the uncertainty lies too, because there's going to be little incentive, let's say, to compromise the effective functioning of the carbon market to hit this 20 billion target. They're not going to sacrifice that. And there is a risk that they do by putting more supply into this market. And let's face it, the 20 billion euros is a target. It wouldn't be the first time we've seen the European Commission, let's say, miss a target that they've set. So I think it will be a balance. But ultimately, right now, what the European carbon market needs is certainty from the European Commission and some forward guidance about when and if we would get additional volumes added to the schedule. That's the key. And I think that would help price formation and ultimately help kind of cap out this bearish trend.
Okay, so let me recap what we discussed. On one side, post-movement of the April date to September, not a big deal, not a major driver. There is a little bit of, less bullishness attached to that. Spark spreads and dark spreads definitely a factor in limiting the hedging, so the demand. And then there is uncertainty on top created by the Repower EU volumes that is coming to market at the moment. So it's all bearishness, which is not really good, as you said, for the energy transition. Does not provide the level of certainty or the price signal that you really want to incentivize the switch from fossil to low carbon fuels, low alternatives. Is this just a temporary market adjustment, or is it something more?
It's definitely a temporary, say, short-term development for the EUA price. We don't see the EUA market trading at these levels for a sustained period of time. But definitely, let's say, for the next 2 quarters, I think bearishness is here to stay. I think the market will struggle to maintain a trading range above the 60 euro level. We can't rule it out, but I think the fundamentals that underlie the EUA market this year are really weak. And this provides a real fragile basis for any moves above that 60 euro mark. So we expect a 55 to 60 euro trading range for the next kind of 2 quarters. And like I said, fundamentals are weak. So this is what's underlying the trend. There is potential, I think, for sentiment reversal. I think the bearish sentiment could fade because ultimately, as time passes, we expect the bearish view of especially the speculative community will become increasingly difficult to maintain, especially if we start to see sort of reversals in macro sentiment with the rate cut cycle, maybe some improvements in the production indexes and the PMIs. And also maybe even the clarity in Repower EU that's expected in the second half of this year can take that bearishness out of the market. And then finally, this market cannot ignore the future tightness forever. We know that the fundamental balance is going to see a significant shift in 26 and 27. And this is creating a lot of upside for the EUA price, especially versus today's level. It's just a question of when the market is willing to price that in. And at the moment, we're in a fairly myopic market that is only focusing on the short-term fundamentals, but this is definitely not a long-term expectation going forward.
Thanks a lot, viewers. That was quite extensive and insightful. I think that there is more to come. There's a lot of uncertainty that needs to be somehow resolved. Not sure that's going to be the case, but at least it keeps things very, very interesting. Thanks a lot. And as always, if you want to know more about Energy Foresight, tune in for the next episode or go to our website, ICIS.com.
Cheers, Matteo.